We have a multiple cluster alert. I'm going to show you where that is. We also saw something in the past few days that we've never seen before in the S&P 500. I'm also going to tell you what that is, why it's significant, how that can impact our posture. I'm also going to tell you and show you why that we currently have a bullish posture, but I don't think we'll be as strongly bullish in the near term as you might think. So I'm going to break that down as to why today's trade idea takes advantage of a stock that's in the news. We'll see how we can trade it. Let's go ahead and get started. Today is Wednesday, June the 20th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thanks for tuning in. Welcome to those of you who are watching us for the first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel by mousing over the Market Scholars logo in the bottom right corner of the video, and then click that red subscribe button that pops out. Click the thumbs up icon down below. Let me know that you liked the video today, that you want me to keep doing these. Comment on anything that stands out to you. Join our daily Market Outlook email list. There's a link popping out in the top right corner of your screen. Click on that link to subscribe. Follow me on Twitter for more content like this, and join our Market Outlook community on Facebook. All right, let's take a look at the S&P 500 with the market forecast indicator. You see that the S&P did rally here almost 5 points. So, it doesn't look like it's that. It actually looks more bullish than it seems. And that's really because this candle here, yesterday's candle, is an open candle instead of a filled-in candle. In fact, I tweeted out someone referred to this stretch right here where we gapped down and finished higher than the open for 3 days in a row and still finished the day lower, which is why they're red. This has never happened before on the S&P 500. Have we ever had that scenario where we gap down every day, we finish higher than the open every day, but we finish lower than the previous day's close every day? So again, that combination of red candles with open candle bodies essentially never happened before. Now, I haven't gone back and looked to verify, but I can pretty much, I can understand how that would be such a rare occurrence. And according to a few people that I've seen now, they both reference that, whether they're referencing each other or not, reference the rarity of that occasion. So that's why this looks more bullish than it does, because you expect that candle to be filled in. Usually bearish candles are filled in. We close lower than the open. In this case, we close higher than the open, so it's not that much higher than the close. Only 5 points, but enough to get the momentum in the near-term lines back into the upper half of the chart. In fact, the near-term line never did come below. It closed at 50.5. So, we've got now 1, 2, 3, 4 days of the near-term line being above 50, which is funny because those 4 days, it still hasn't gotten above 65. We're still, we got 62 as the highest point today. So, usually you get 4 days of the near-term line above 50. Here's 1, 2, 3, 4, and you're in the reversal zone usually. And here we're not close to the reversal zone yet. So we'll see how bullish we end up being on this current near-term run. The posture is strongly bullish here. So, the intermediate line is still in the reversal zone because of this rare occurrence. And the momentum line's avoiding the reversal zone. We did have that one little spike down here. With the rising market sentiment, it's kind of hard to put a whole lot of stock into that extreme low point, as we didn't back on that day. So, short-term sentiment's improving. It looks like we're bouncing off of that low point as of right now. We closed above yesterday's high point, so close above the high of the low day if you're looking for that. So that's a positive sign from a bounce perspective. When you look at the Dow Jones Industrial Average, again, it did not bounce, so it fell. The tariffs news affecting the Dow more than anybody. You do notice that you've got the possibility of a bullish near-term divergence. So here's the low point right where my cursor is with that near-term low, and currently we are much lower on the Dow itself, but the blue line is forming a higher low point. So that divergence between higher near-term lows and lower lows in the index is a bullish sign. And considering we're sitting still in that Fibonacci retracement zone, above those high points there where my cursor is, there's opportunity for that support to hold. and for things to turn around. We are bearish, but it's light pink on this shaded area here, which means the intermediate line is dropping, but it's not below 50 yet. That's where it gets darker pink, and that's where you usually get some red lines on this moving average, which we're not red yet. And it also means that the timing of this intermediate run would be over with. So, it started back here at the beginning of May. We are now over a month, almost a month and a half into it. The typical time frame is 2 to 3 months. For the Dow, S&P, we're still going strong. For the Dow, it's a little tenuous there. The Nasdaq and the Nasdaq and the Russell are forming overbought clusters again today. The Russell's got 4 in a row now. 4 overbought clusters in a row, and this one very nearly also including the market sentiment line too. Now that doesn't necessarily mean this one did include the market sentiment line, and we did pull back briefly to a higher low and bounce. So this isn't an end all be all, but it just kind of shows how strong the Russell 2000, and also kind of shows too that this tariff news, while yes it is impacting a segment of the market, in particular the Dow Jones Industrial Average, it's not impacting risk appetite as a whole. If it were, then there'd be a lot of stock into, this tariff is going to cause bear markets, going to cause recession. That's not what the broad market is pricing in. The broad market's not looking at these tariffs as impacting the overall economy and earnings expectations for these companies. And we see that with how the NASDAQ and the Russell, which are far less impacted by that news anyway. But I know that tariffs don't impact small cap stocks nearly as much as industrial companies, these multinational industrial companies. So I know that to be the case. But what I'm talking about is a broad sense of risk appetite. Is the tariff news impacting risk appetite in a broad sense? And the answer to that, according to the Russell, is no. I mean, we are as strongly bullish as you can be. The same thing with the NASDAQ Composite. Strongly bullish as you can be, according to that overbought cluster signal. I did want to point out really quickly before we look at the other charts that our window for our discount offer here ends at the end of July or end of June. So we got about 10 days left. I wanted to highlight that. Here's the link right here to click on to get more information on what we're offering during this early access period that, like I said, ends at the end of the month, and why the discount, right? There's some information on there as well as to why we're offering the discount. There are a lot of people who have taken advantage already, and you can hear why they did that here in the if you click on that link and go to the forums. A lot of great comments. So if you're wondering whether you should or why you should do it yourselves, no better place to see from what other people already have done and see why they did it and what value they're already getting out of it. Now, really quickly too, 3 clicks we look for night in and night out. That tell us that you think we should keep doing these videos. One is right here on Twitter, on tonight's Market Outlook tweet. I've got it embedded right here. So you can click on that heart right now while you're watching. You can also click on the thumbs up if you have a Facebook account right there. And of course the green button. Now I've noticed, again, only 11 people there. So, like I said, we look at these every night to see whether or not, there's still demand and interest and whether or not these are effective for you, that you're learning from these and that you're getting value out of these. So those are really, really quick and easy way to tell us while you're watching the video right now. Just scroll down below. All right, let's take a look at the long-term chart. You can see we still, even with this little pullback we've had, we're still above the 50-day moving average. That's not the case for all the indexes. The Dow Jones is actually below its 50-day moving average, and it's falling. Still above, it's rising. But you see how the MACD for the 50 and 200-day moving averages is also slightly rising, which means the gap is getting bigger. Because the 50-day is falling, the gap's actually getting smaller. So the Dow's a lot more bearish from that perspective. The NASDAQ is actually almost as bullish as we were at the beginning of the year when things were crazy. So again, we're kind of getting back to those extremes. Same with the Russell 2000 here at 85 is about as high as it's been. Now, obviously, it wasn't as bullish at the beginning of 2018 because we had more of a pullback here than we had on the other indexes, like we're seeing on the Dow. We were actually a lot more bullish coming out of the election. It was really extreme. 4 weeks, 1, 2, 3, 4, 5 weeks, we had gone from 1163 up to 1388, so over 200 points in 5 week period. That was a tremendous move, and you see that reflected in the long-term momentum. But we're getting to that point again. I mean, look at the 1, 2, 3, 4, 5, 6, 7, 8 weeks in a row, and 10 out of the past 11 since this kind of 3 out of 4 pullback. So that's a pretty decent move coming from below the 50-day moving average with the green arrow. And same, the NASDAQ, very similar. We had that one down arrow right there, but similar with 1, 2, 3, 4, 5, 6, 7 out of 8 weeks with bullishness. So continuing to show bullish signs, and of course the 3 green arrows. We don't have 3 green arrows yet. The MACD hasn't turned back up yet. When you look at the 3-line version of this chart, you can see how we did dip below and tested the 30-day moving average. We didn't close below the 17, so we closed back up above it by the end of the day yesterday, and now getting almost back above the 8-day moving average today. The MACD and stochastics are still below the moving averages, and they're both falling, so there's still some weakness, but not trend-changing weakness on the 3 green arrow chart. Of course, when you look at the Dow Jones Industrial Average, again, a little different. You can see we are below the 8-day moving average. The MACD is actually negative now. It's dropped below 0. Stochastics is close to dropping below its midpoint too. Actually, the MACD is not negative. It's at 1.72. It's almost negative. The 8-day is basically sitting on top of the 17, which is what that number represents here, the gap between the 8 and the 17-day. The 8-day being the green line, the 17-day being the red line. They are both still up above that moving average, but you can see the price isn't. So that's why you got some weakness there. But then you look at like the NASDAQ composite. NASDAQ composite, if I can type the symbol right. Up above the 8-day moving average. MACD is high. Stochastics and its moving average are both high. The Russell 2000, way up above the 8-day moving average. Hasn't come down below the 8-day moving average this whole time. So it just shows how extreme that is. MACD is above its moving average at very high levels. Stochastics and its moving average are both up at very high levels as well. So strongly bullish here, and you can see these numbers. Look at that 3-month return. It's very high. Compare that to SPX 3-month return, which is almost about its long-term average. 2.2% is its long-term average. And the Dow Jones Industrial Average, 3-month returns not close. So it's kind of, we're seeing a discrepancy, again, because of the tariffs, where the Dow is down, but not anything else, right? And this is a very small subset, 30 stocks are all that's in there. And we actually got rid of GE. GE had a small impact. This is very, this isn't market cap weighted. This is price weighted. So the higher price stocks in the Dow Jones Industrial Average. In fact, if you, if I were to show the Dow Jones Industrial Average here, public, and then Dow Jones Industrial Average. So here's the companies. And if I were to weight the averages, so GE is getting kicked out. All right, and so it's gonna, but it had the least impact out of any of the stocks anyway. So its weakness wasn't really impacting this. What is impacting it is the companies like Boeing, which you can see the chart looks pretty much exactly like the Dow Jones Industrial Average, because it's got the highest weighting in the average with the price, and you can see some of these others down here that aren't nearly as high priced. Won't have nearly the impact either on how the index is performing. Today's bounce got us up above yesterday's high. In fact, we spent the whole day trading. We gapped above and spent the whole day trading above yesterday's high, but we're not able yet to get above the previous day's high, which was Monday's high point. Monday's high point was Friday's high until that kind of late push there. So in this line that I've drawn is a 23% Fibonacci retracement of that level. So you can see that 276.75, that was something I mentioned in class today. I taught an options inventory class that was kind of the level to watch to see if we get above that. If we get above that, then we're getting, the next target was 278.25. and we never did. We held it for resistance and came back down and traded near the low of the day. Not very much of a gap between the high and the low, so not as bearish as you would expect it to be when you finish at the low of the day. Very, very, very tight range. Go back to this chart here on the S&P 500, and you can see the range was less than half of average. So very, very small range there. Then when you look at the this chart, you can see the ATR relative to the price remains in bullish territory below 1%, and the volume too continues to move to the downside. So it's below, it's trending lower. Let's take a look at the volatility index, the VIX, and you can like other days, the VIX is kind of starting the day high, and this is the highest that it started today, or excuse me, yesterday started the highest. Today started up high again before coming down very, very tight range below 13, very, very low volume. Here's something I tweeted out today too. And remember to follow me on Twitter to make sure you're getting this content that I put out there. And sometimes I share that other people have put out, like Ryan Dietrich. 10 days in a row that the S&P hasn't gone up or down 0.5%. That's tremendous. We haven't had that long of a streak since 2017. And somebody commented on this, didn't expect that you would see any kind of comparison to 2017 and 2018 with volatility expected to be higher, and that's definitely not the case. All right, so volatility is low on an absolute basis, and of course on a relative basis, we're still in that bullish zone for most of the days, sitting right in the sweet spot at 85% relative to the 3-month VIX, VIX 3M. So to summarize, the postures remain bullish except for the Dow, which is the most impacted by this headline risk. Everything else shows that the market as a whole and risk appetite as a whole is not nearly as impacted by these headlines as a small subset of companies are. And we've had some short-term pullbacks, which is normal no matter what the headlines are. And as of right now, bouncing. How long will bounce? I don't think the S&P will bounce. Typically, we're already only 4 days on the current bounce, and we haven't gone up very much in the near-term line. I don't think we'll get a good, solid, normal near-term bounce here because we haven't got the pullback yet in the short term on the Russell or the Dow or in the NASDAQ. And so until we get that, we're, inhale and exhale, it's kind of a regular pattern. And, you can't take a deep breath in forever. And the longer you do, the bigger the exhale will be. So that's kind of what I'm watching for. Until we get the exhale on that small cap index, then any inhales, any impulse moves on the S&P are probably going to be smaller and more frequent, right? You'll still might get higher highs and higher lows, but they won't be the typical 7 to 12 days. It might be like 4 to 7 days before we turn around, and we'll get more choppiness until the Russell rolls over and the NASDAQ rolls over as well. So what do you think? Do you agree? Do you disagree? Let me know with the poll. It's popping out in the window here at the top right of the screen. Click on that link and tell me if you disagree. Comment down below on YouTube. Love to see what you're thinking. Let me know if you see something that we haven't chatted about that impacts your posture differently than what we've discussed. If we take a look now at what's driving the price action here, you can see the biggest mover today was IWM, small cap index. On the other end, the safety trade, small cap, and you can also see commodities were up, emerging markets were up. So this was risk on here, and this was all risk off. You can see preferred stocks down, foreign bonds lagging. You have gold and long-term bonds down, which mean yields were higher. You can see that this was over the past 2 weeks, the dollar's been the best performing asset class, and that's what's put so much pressure on emerging market stocks. That's the tariff. That is the impact of this tariff news is impacted. So here's the impact of U.S. stocks, and you can see during this time that's been really kind of big in the headlines, small cap stocks are actually now positive. Large caps are negative, but small caps are really outpacing during this period of time where it's been in the news. And the emerging markets are getting hammered, and they're really lagging behind. The dollar is strong. This kind of news helps the dollar. Obviously, the big jump in the dollar was from the FOMC raising rates, and with the idea, and even today, with today's news here on the economic calendar, the Fed chair spoke today about the need still that the economy is strong enough for continual rate hikes every quarter. Talked about the labor market, and the unemployment rate's at very low levels, but wage inflation is not at very high levels, which means that the employment market is not as heated or overheated as it would appear based on the headline data. That once you dig in, there's still a lot of improvement that can be made in that participation rate rising. So remember, if you're not trying to look for work, then you're not unemployed. Even though you're not working, you're not unemployed unless you're looking for work. And so that's where that participation rate comes in. And so there's still room for improvement there. And that's what we noted. The reason why we know there's room for improvement is because that wage inflation is still pretty static. You would expect it at this unemployment rate, you would expect wage inflation to be growing a lot more than it is, and just isn't. That's a structural shift that we have, obviously, in the employment sector. So you can see that, go back to this chart here. You can see that the U.S. economy is doing relatively well, and you can see that as well in the economic surprise index. It continues to be, slightly positive, but much more positive than what you're seeing globally. Because remember, it's only at negative 33 because of this 10. Everything else, some of the Eurozone areas is way down here. So that's another reason why you see the dollar being as strong as it is. Again, commodity prices, you would expect eventually crude oil, you see crude oil's up, so it's bouncing back up here after pulling back. Gold falling simply because of that strength in the dollar. In fact, you can see here's the dollar strength bouncing back up after the FOMC meeting. A little potential for a divergence there, so I'm going to keep my eye on that and see if it continues to trend higher. If you take a look at the futures contract for crude oil, it's in a bearish trend. It's below a downward sloping moving average. And same thing with gold, bearish trend, down below a downward sloping moving average. But gold is showing some oversold clusters, which has been, you can see, a reversal point in previous instances. All right, now let's take a look at the sector rotation. Again, over the past 2 weeks, the consumer stocks are doing really well. And again, the last 4 days or so has been when we've had the bearishness with the tariff news. And you can see that hasn't impacted these consumer stocks in the U.S. Or utilities. And utilities still an outperformer over the past couple of weeks. But these two areas continue to be weak, and they are impacted the most by the tariff news. And that is industrials and materials. Energy to a small extent because of their consumption and use in those sectors, industrials and materials. So it's down a little bit. You can see financials, even with today's rise in yields, financials lagging behind. In fact, they were one of the worst performers today. Real estate being an outperformer with that strong existing home sales data point. Healthcare, there's real estate. Healthcare also being an outperformer over this past couple of weeks. Despite a small pullback the last few days, still an outperformer over the broad market. And you can see, so here's the sector rotation chart ordered by today's performance. And the winners, here's the S&P 500. So everything outperforming the market are your winners. I mean, they have strong intermediate, 3 of them at least have strong intermediate postures with intermediate line above 90, rising moving averages. The ones that don't, real estate, you are still above a rising moving average, and its intermediate posture is improving. So you have a little bit of a bounce that's got going on. And energy has, basically pulled back to Fibonacci support and is trying to bounce off of that. It's got a bearish posture, but not below a falling moving average yet. So still got that opportunity to bounce and be strong. Here's your week. So here's all the sectors over here. These 2 and these 4 on the bottom row, all underperforming today, the S&P. 3 of those 6 are bearish postures. And, the financial sector is below a falling moving average. Materials, not yet. Industrials, not yet. But you would expect them to because their posture is about to turn strongly bearish, almost falling below the 50 percentile. And then the other two, these are they've been weak. They're trying to show some improvement. Utilities and staples are just starting to they've been so beaten up. They're starting to bounce back up. Staples in particular, and utilities, still got a yellow line there, so we're not above a rising moving average yet. It is green, but not quite above 50 yet. So there's opportunity for some outperformance. You see, it's been a good performer the last 2 weeks, but still not quite showing the trend, the relative strength yet to support a decent trend. And remember, when markets are bullish, there won't be 100% correlations. When things go down, when things are bearish, then they all look the same. But when they're bullish, we kind of have to pick and choose. And you see the market leaderships, technology and discretionary, continue to be, and healthcare now, continue to be market leaders. Those are the areas where we're looking for, if you're looking for bullish opportunities to maintain, that's where it's at. Of course, the one stock that's been in the news today, overnight, because of the drop of GE out of the Dow Jones Industrial Average, it was replaced by Walgreens, of all companies. And look at the chart, you can see Walgreens really benefiting. It's been a depressed stock here for looking very similar to the XLP, to the consumer staples area. Not so much the healthcare sector, but more the consumer staples. Lots of clusters showing up back here, and we've been basing ever since. Stocks will tend to base, not the indexes, but stocks will tend to base over a period of time. And you can see we've got multiple high points here with the intermediate line getting above 50. Well, this is the first time we've gotten above both of those. On a closing basis, we've gotten above both of those closes on the intermediate line. So, that my strong move today, of course, we know why, and we know why there's a lot of volume on a day like today. Here, let's pull up WBA on this one. A lot of volume. You can see MACD and stochastic, 3 green arrows. Obviously, the spike in volume. They are above the large range, which doesn't account for the gap. You can also look at the Bollinger Bands. We're closing way outside the Bollinger Bands. And again, like I said, above those highs too. It's a very positive point. The Bollinger Bandwidth has got room to go. It doesn't have to go up very much, though. As we know, we can make trades where as long as it stays bullish, that's what we want. And then finally, if I look at the DMI for WBA, the directional index, you can see crossing up above 25 too on the positive directional index. So positive development there. The ADX shows that it's got room to grow in the trend. So a good sign for now. Again, this won't impact the Dow very much. It is a cheap stock. So, go back to the Dow Jones Industrial Average here and, sort it by its current price. And it's going to be down here, like Nike, and a little bit more than Merck, another stock we've looked at here recently. So, it's not going to have a big impact on what the Dow does in terms of bouncing it up. But, being a part of the Dow, as you can see, has been a positive for the company to help it from a technical perspective break out of the basing pattern that it's had over the past few expiration cycles. And so we'll see if we want to say, okay, well, we look at 30 days out, that puts us to this next dotted line in July. We can still get pretty decent for a $2 wide. We can still get that 40, more than 47 cents, which is enough. 47 cents on a $2 wide gives us a 30% return on risk. So I can do that credit spread here, and I can even go out to get to that 1% risk on a hypothetical hypothetical $100,000 active trading account. You can see I can do multiple contracts to get to that point. Get decent credit. It's got a high probability of success, and if you look at where this blue line is where that break-even price is. So as long as we hold today's low point for support, then our losses. Let's see, what was it? 7 contracts. So our losses, our maximum loss is $1,000. But if we get below, there's that break even. Our potential gains 378. So we can keep our loss to 378 or less as long as we stay above today's low point. When you have a big gap like that, it will act as a support, especially when that level also there happens to be multiple high points at that area that can help it stay above the support as well. So let's talk about tonight's market outlook and tonight's trade idea in our market outlook forums on marketscholars.com. There's a link that's popping out in the top right corner of your screen. Click on that link. Subscribe to our site if you haven't already. You can do that for free. And let's talk about tonight's market outlook. If you have any comments on today's video, if you have any questions about it, if you have any questions or comments on today's trade idea, post there in the forums. Make sure you tag me at SettleDA. So anywhere in the post, if you're asking me a question, put in there at SettleDA and the topic. That way I get alerted when that topic gets posted in the forums and I can check it out. Again, have a great evening. Thank you very much for watching. Like today's video on YouTube and click that thumbs up, subscribe and comment down below. Follow on Twitter for more content and join our Market Outlook community on Facebook. Again, thank you. Have a great one and we'll see you all next time.